Hello, my name is Andres, and today I'd like to talk about the trading indicators. The trading indicators are crucial in the technical analysis as they are providing us with a mathematical overview and demonstrate the possible chart movements in the foreseeable future. The first one is the Relative Strength Index or RSI. That shows us the divergences between the main chart and indicator using which we can predict the changes in the chart. Usually, RSI is based on the 14 days timeline. It is possible to choose the different ones, but 14 days is long enough to demonstrate a trend and short enough to demonstrate the dynamic changes. The RSI is being calculated by the average gains divided by the average losses. Uh, Both gains and losses are taken within the period, in this case 14 days. And as we see at the graph, in case of the bearish divergence in the we are observing the higher highs on the chart, while the indicator shows us the higher lows. When there is this divergence happening on the indicator, it is possible to assume that shortly the market will come into the position of the bearish market, and it's better to go short or sell the assets that have already been obtained. In case of the bullish divergence, the chart is going to be demonstrating uh, the lower lows, while the indicator will show us the lower highs. In this case scenario, it is possible to predict that market will go bullish, and it is a very good idea to buy some securities. Then moving averages. The moving averages is a very traditional mathematical way of looking at the set of data. The moving average is being calculated by taking the price uh, of the security within the given amount of time. In this case, there is a lot of possible ways to choose the time frame. If we choose the 8 days, for example, it's gonna give us the more dynamic, more ever-changing graph that's gonna be more close to the chart itself. And we can also go to 20, 30, 40, 50 days up to 90, for example, and it's gonna be giving us more general um, price movement. In this case scenario, rather than being dynamic, it will more like be showing the trend itself, and will make us more confident that market is going in a particular direction. The short-term EMA is nice to use when looking for the bounces of the chart. Like for example, in the middle here, we see on the indecisiveness of the market, a lot of red candlesticks with the green candlesticks, and the presence of this bounce with the doji candlestick right above demonstrates us that market undecisiveness gonna lead us to either creating more gains and the market will go uptrend, or by contrast going down. With using the other indicators, it helps us to predict the trend and make a well-judged decision of whether we're gonna go long or short. The MACD is a indicator that shows the 12 period EMA minus 26 period EMA. Exponential moving average is basically the same as the weighted moving average in the statistics, which says that the recent days are more weighted than the last days, showing us that the days that have just passed are more representable in terms of data. Therefore, we are putting more weight on them in terms of coefficients, thus making more clear graph. Uh, MACD comes along with the signal line, which is usually taken as a period of 9 days or 9 weeks, the period of nine. The digit nine has been chosen because not uh, it's not too much days, which means that the graph gonna be both dynamic and it's not too little days, meaning that the graph is not gonna be too generalized. Uh, Therefore, 9 days is more suitable for the MACD, but obviously traders can choose their own periods depending of what fits best. It's generally recommended to buy a security when the MACD line crosses the security line, and sell the security when the when MACD line gonna go below the signal line. Um, Usually, it is a good idea to combine different indicators. For example, there are strategies of combination of RSI and MACD. For example, we look at RSI. We see that RSI is above the middle line, meaning that the momentum is high. RSI is basically a derivative showing that it goes from zero to the positive number, meaning that the momentum increases and we go buy it right now. There's a lot of dynamics. And if it matches the MACD line, showing us that, yeah, MACD line at this particular moment crosses the signal line, which means that the EMA demonstrates us that the average price becomes nice for making an investment. Having those indicators combined, we can make a well-judged decision to make a purchase. Uh, Therefore, indicators are an essential way and give us a lot of opportunities to make decisions on the future purchases. Thank you for your attention.